Hey there, traders. Ben Watson with you. We're going to talk a little bit about earnings announcements and expected moves and market maker moves for stock prices. So let's jump into it here really quickly. A couple of quick reminders though. Remember, everything we talk about simply for illustrative and educational purposes only. And if you're going to trade options, remember options are risky. They require attention, and you need to make sure that you have an understanding of the characteristics and risks of standardized options before considering any option strategy. So let's jump over here to the thinkorswim desktop software platform. We're going to take a look here at Micron. MU is the symbol. Again, not a recommendation, but you notice on today's earnings announcement, the price of the stock really from open to close gapped up on the earnings announcement up to the 256 range and then made a move back down at the close to around 249. Now, the high and low were a little bit higher than that and a little bit lower than that, but the range in which the price of the stock moved was about 7 points open to close to the downside. Now, that's after the gap up on the earnings announcement. So the net movement was higher, but the daily open to close range, 7 points to the downside. Now, let's take a look at the options market and what the options market suggested that the price of the stock might do. And we're going to do that by going over here to the trade tab. Now, we're going to talk a little bit about options here. Remember, when we talk about options, make sure that you have an understanding of the characteristics and risks of standardized options before considering any option strategy. Now, we're going to take a look at two things here. The first area that we're going to look at is the market maker move. And the market maker move comes in anytime that there is a differential between implied volatility in the most current expiration date and then the next expiration date. And then that is a proprietary calculation to look at the expected move on whatever the event might be that's creating that implied volatility differential. So you see that right now the option series that expires on the 19th of December has a 91% implied volatility, and the next expiration has about a 58% implied volatility, so a big differential there. Then that proprietary calculation comes up with an expected move on the earnings announcement of about $6.71 up or down. Now, our actual move on the announcement, net open to close, was about $7, so that got pretty close. Now, the other side of that equation that we are going to look at here is the expected move for the most current expiration, and that's that 19 December expiration. Once again, we're going to come over to the right-hand side. We're going to look at the current level of implied volatility for that expiry, and then we're going to come to that number to the right-hand side of that volatility number. That move expected is plus or minus $8.27, which is a little bit more than it moved. So between those two, between the market maker move being a little bit under and the expected move on that current expiration time being a little bit over, we get to somewhere in the middle there, and that's about that $7 move that we saw here on the price of the chart from that open at 256 down to the close at about 249 or so. And you can see where the options market was dialing in on that earnings announcement move. And oftentimes that number is going to be pretty close. Now, a couple of things to keep in mind. The options market tends to be a little bit more exuberant about movement in the price of the stock. So it tends to over-expect price movement. So some options traders detune or attenuate those expectations a little bit when they look at that market maker move or the expected move here. And some traders may look at that and split the difference between where that market maker move is and where that next expiration expected move might be. And you've got to remember those numbers are also plus or minus. So the price of the stock could go up, the price of the stock could go down on the earnings announcement. One thing to take away from this too is that even if we knew what the numbers were going to be, even if we had an expectation of, or we knew somehow what the numbers were going to be that the company releases in their earnings announcement, we don't know how the market is going to react to those numbers. And so this is, again, looking at a positive or a negative movement in the price of the stock. So in this particular case, MU moved down 7 points. The option market got it just about right, but we only see that obviously in hindsight. So a couple of things to keep in mind there when we talk about earnings announcements and expected moves. But that's how you can look at it here on the Thinkorswim desktop software platform. We'll look for you out there in the Trader Talks webcast. See you very soon. Bye-bye.